Good evening, ladies and gentlemen. It has been some time, hasn't it? Probably about 4 months since my last live stream, and I wanted to offer some updates, some changes, some personal perspectives on what is going to be changing with this channel. My God, life has been taking me for a whirlwind between funerals, family stuff. We're trying to buy real estate, get our life sorted out. It's been very hard to make creative content, I'm going to say. Since 2019, when I started this channel, I've watched a lot of people come and go. A lot has happened in this market environment. My portfolio has grown massively. And because of you guys and the position this YouTube channel has put me in, it's giving me a healthy position to start getting my life together from a living circumstance, which I think I don't know what else to say other than thanks so much. So the new live stream that I want to start doing for you guys to kind of start giving back, I'm going to start making a lot of different content. So we're going to be doing live streams weekly again, hopefully starting next week. It's going to be stocks to buy, where we're going to review obviously the weekly market news, what's going on, my interest, what interests you guys, so we can start having this regular conversation again every single week. Outside of that, the content I've been doing has been too continuous and it's been too laxed for me, I'm going to say. I'm always just sitting on my butt here, talking about stocks, doing sponsored videos, and just whatever comes on my mind, with the skew of amount of times I've changed my portfolio. And I want to do something different. I'm trying to creatively come up with something that I think is more giving, not only to you, but to my creative self. I'm not going to spoil what I'm working on. I'm hopefully going to get something in the works next week. And I'm going to start making my Monday or Tuesday videos a little bit more creative and outside of the box. How that's going to do for this channel, I do not know. But thanks to the grace of God, I thank you all so much for allowing this channel to continue to grow, even with all the controversies. And the YouTube space has definitely become much more controversial in the finance space ever since the last couple years. I'm going to get through a few things here, and then we're going to kind of get into some comments, some questions. I do want to recap the market a little bit. I want to answer some of your questions that you posted on my prior videos. And I think we should kick it off with, first and foremost, I think the market is changing. I think what we're about to see happen isn't going to be fun for us as users across the broader internet for at least the next year or two. And that's because companies aren't growing anymore. There's just no revenue growth. No one's talking about fundamentals of businesses like they used to, because we're back into this momentum phase. And we're starting to see it with companies like Netflix. And I think Netflix really started to kick it off by cutting off users from, multiple password sharing. And that is working to their favor. Companies are seeing that is working to their favor. Every company, Google, all these guys just want to start confining gross profit. There is no longer a big growth market like there was. So what do you do when growth is dying? You look to refine the business and find the flaws and bring gross profit up, because so long as revenues stay flat, doesn't mean you can't make more money than ever. So Google's kind of moving into this phase where they're going to try and prevent people from using ad blockers now. And obviously, a lot of us have been pampered by free content, by password sharing. So, hey, maybe we've all been a bit hypocritical in taking advantage of the internet. I am somebody that loves using ad blocker, because you just look at I live on YouTube. I don't watch a lot of TV shows. I've lived on the internet my whole life. And the amount of times you got to cancel and skip out ads, which is super hypocritical from somebody that most of their business does rely on ads, sponsorship, things of that nature. But I think there's some kind of cohesive manner where you can make this work a little bit more. I tried using Twitch, and I can't stand Twitch ads. They are by far worse than Google. I think Google's got a nice system going. Twitch, if you've ever used it, I watch live streams on TikTok. I'd rather watch them there than on Twitch, because the ads that pop up are just way too intensive. I think I got one time where there were 6 or 7 ads that lasted like 3 or 4 minutes. So I think this is going to be a changing phase that a lot of us are going to have to get used to for the next little while, as companies refine, layoffs, all that stuff. But I also think we're in this interesting time where it comes into these billionaires and these new moguls fighting it out, man, because I've never seen Mark Zuckerberg in this light before, where he is competing now with all the big players. I mean, Google, Facebook, they kind of used to be in their own little realm of things. But now there's this convergence happening where these companies have so much money, they all want to compete in the same landscape. And I'm only going to show you a few highlighted clips of this, because I think Mark Zuckerberg, in his mind, I think he's so future forward looking that we can't truly understand the scope of where he wants to take Meta, whether it's VR, whether it's blockchain and crypto and NFTs, and integrating all of that stuff together into some future stuff we're not going to see this for like 5 or 10 years. But it's nice to know these guys are like, with all the money they have, they're still working on this stuff. But I thought this was great because he wants to compete with Twitter, and I can kind of see why Elon Musk and him have been going at it on.
I have to ask, there's rumors you might be working on a social network that's text-based that might be a competitor to Twitter, codenamed P92. Is there something you could say about those rumors?
There is a project. I've always thought that sort of a text-based kind of information utility is just a really important thing to society. And for whatever reason, I feel like Twitter has not lived up to what I would have thought its full potential should be. And I think that the current, I think Elon thinks that, right? And that's probably one of the reasons why he bought it. And I do think that there are ways to consider alternative approaches to this. And one that I think is potentially interesting is this open and federated approach, where you're seeing with Mastodon, and you're seeing that a little bit with Blue Sky. And I think that it's possible that something that melds some of those ideas with the graph and identity system that people have already cultivated on Instagram could be a kind of very welcome contribution to that space. But I don't know, we work on a lot of things all the time though too, so I don't want to get ahead of myself. I mean, we have projects that explore a lot of different things, and this is certainly one that I think could be interesting. But
so what's the the launch date of that again? Or
yeah,
what's the official website? And
well, we don't have that yet.
Oh, okay.
But
all right.
all
right.
And look, I mean, I don't know exactly how this is going to turn out. I mean,
so yeah, Mark Zuckerberg, I don't even think he knows how much stuff he wants to do with all of this. It's insane. It's just insane though, because Twitter's been an utter nightmare now. That like I go on Twitter. I don't have a Twitter account, and I'll go on Twitter. And I can't even get in anymore because I just never wanted to get an account. So they blocked me now. I can't even get in without making an account. I don't think he's Steve Jobs, but I think he's got so much money, and I think he understands what the future is going to look like. And I think he's very forward looking, which I like as a CEO. I mean, we still have exposure to Meta. My fiance still has a decent sizable position in Meta. And I'm hoping at some point, once I kind of get this real estate stuff figured out and I can remeld my portfolio and get everything sorted out, I'll give you guys the full scope of like our precious metal holdings. We still have crypto holdings, our individual stock. I mean, there's so much that I don't show you guys that I've been trying to save mostly for the Patreon members, but I have been really lacking on that with everything that's been going on in my life as well. But putting that aside, I'll get into some of your comments, questions here, because a lot of you posted some pretty funny stuff over the videos I've done over the last week and a bit. This one was pretty good. Did you just say value doesn't matter and buy these ridiculous valuations if you're in your 20s? That is literally the worst thing one can do if they're in their 20s. You don't need hyped up and flashy companies to get amazing returns. Didn't you do a TELUS video recently and showed the incredible returns over the last decades? And I think this is like one of the trickiest questions I have troubles answering today. Is like, if I was 20 and I was doing it over again, like how would I do it? Firstly, outside of the stock market, I would move. I live in a very expensive place. If you're in Toronto or any of these expensive cities, it's time to get out because inflation is going to ruin your life. Even if you're making a six-figure income in your 20s, the cost of living here has just gotten so out of control. You might as well leave. The second thing is when it comes to investing, I can only speak for myself. And if I listen to people that I watch on YouTube now that say, oh, just buy VTI until you motherfucking die. That's all you need. I get it. But I wouldn't be in the position I'm in if that's what I did. I mean, I made huge money in the early days of the MJ market. I wouldn't have bought Tesla. I would have been in a position where I wouldn't have got into things like MindMed. I wouldn't have seen these absurd returns from doing due diligence and catching trends and doing things that I still fully love doing. So when people say, like, when I look at these valuations on these stocks and I'm 20 years old, I bought stocks that were expensive back when like 6-7 years ago. When I bought Apple, everyone told me it was overpriced. And I made like almost it's 800+% return or whatever. Like the returns I've seen because people told me things were overvalued, I think we're just wrong. And I just think if you're younger, it's the only time you can take on speculative risk. I just think once you get into your 30s and 40s, you can't afford to take on such large assumed risk without detrimenting your retirement. And it just becomes harder and harder. I don't think you should steer away from buying index funds. I think you can do that, but to take on with a little bit of money you might have saved up to buy a handful of riskier investments isn't going to ruin your life in your 20s. I mean, you could have 10 grand in your name and blow it all up, and you still have the next 40 years to figure that out. That's why when I'm saying like you could buy Tesla and not care if you're in your 20s, because if you believe in the company, like I said, for me, I'm trying to be a little careful with it. But if you're in your 20s, who cares? Who cares about value on certain companies? If you believe in them, if you think there's potential into the speculative future, take it on, give it 10 years to see what happens. And who knows, maybe it shoots up dramatically like the luck that I found, and you can take profit and continue to diversify. At least that's what I'd hope happens to most people, right? And taking that into perspective, when we're talking about even the S&P top 10 companies, some of the strategies that I've looked into specifically with picking larger cap companies, the top weightings, trying to get advantage of people flowing money into index funds where they largely keep buying into Apple and Microsoft. So that's how Apple continuously hits all-time highs, right? Money market funds, all this cash that's been sidelining that's now piling into indices. all that money just floods to these top companies, and it continues to. So they can continue to get more and more expensive, and they could remain expensive for the next decade, or maybe they don't. Maybe things come back down to a nominal pace. But if you asked yourself that back in the early 2000s, just during the dot-com bubble in 2001, if you bought even the top 5 companies, let's just kind of speculate on how you would have done, because you would have been owning General Electric, Microsoft, ExxonMobil, Pfizer, and Citigroup. I mean, Walmart's up here. A lot of these companies still exist today, but let's just presume you didn't buy anything else and you just focused on those 5 companies. This is a very hypothetical and has no relation to picking individual stocks or how I did it. I just think it's a fun little thought experiment, right? So if we take a look at General Electric, you would have been decimated since 2001. You'd have been down 70%. Still had money. God knows what the return was if you just had dividends, because God knows you 20 years of dividends at a General Electric, who knows where you would have been. But 70%, if you put 10 grand in, what are you down to? 3 grand. Okay, not the end of the world over 20 years. You take a look at something like Microsoft, you'd have been up 500%, with most of that coming in within the last 5-10 years. And again, not including the dividends, but I can imagine your dividends would be absolutely absurd if you own this thing since 2000. That would have probably made up for any kind of crazy losses that you've experienced in General Electric, and then some by leaps and bounds. You look at ExxonMobil. If you bought this one back in the early 2000s, you'd be up 159%. This one's been a big dividend payer for a very long time. So you would have done probably pretty exceptionally well. You take a look at something like Pfizer, for example. Pfizer is one that has never, well, it only just recently recovered from those 2000 dot-com era, and now you'd be down on it. But again, you take a look at that long term, the dividends this thing would have paid out, the compounded dividends, if you reinvested them and you never put another dime into it, you'd probably still be up pretty substantially, right? And Citigroup, you'd have been decimated. US bank stocks, I'd pick Canadian bank stocks any day over the week, but you'd be down 91%, and it'd been the worst of the 5 stocks you picked. I'd have to run the math. It's very hard to actually run the math to see if you would have outperformed the S&P 500 just picking those top 5 stocks. But again, if you're in your 20s, I don't think it's the end of the world to be doing this. I don't think it's the end of the world to look at some speculative, lower cap weighted companies, pick a few large caps that you really like, and handpick maybe 3, 5, 10 stocks. Buy them, because that's exactly what I did. And it worked exceptionally well. Not that that's going to work for you. Not that that's financial advice. Maybe you're making a fortune as a kid and you don't need to worry about it because you got a great job. I didn't have a great job. I was barely making 40 grand a year through my 20s, literally only up to the last couple of years. And I needed to see better returns and excel my income. And I saw the stock market as a potential opportunity to do so. So I don't like steering people away from individual stocks. I think to a large extent, it could be detrimental to somebody, and it would have been to me if I just listened to those people. I would have missed out on way too much. Moving on, Mr. Melray says, if you look at the history, many periods in which only dividends were the return, the next decade might be the same. This is a convoluted metaphorical question here. I mean, think about it, right? I don't know what the next decade looks like, because everyone's saying we're going into a lost decade where returns are going to flatline. Market has no reason to keep going up, but I just can't see it. Because of technology, right? We're not in the same era that we were from even like the 1980s to maybe even to 2010. We're in an era right now where the evolution of technology is so exponential that it's going to offer much more gross margin compression. You're going to see a lot more growth from companies that can utilize AI and tech. McDonald's is a prime example. You go into any McDonald's now, they've cut down the staff probably by half of the people taking orders. I mean, that stuff is going to compound at a rate unlike anything we've seen. It's kind of like talking about when you go back to the 1800s, from like the steam engine, the first car, the first plane. That stuff took a very, very long time. Now it's like every single month, there's just a new innovation that's crushing jobs. I mean, even in the last short while, and it's terrifying for younger people. I mean, you look at, I was talking I was not talking, but I was on Reddit reading this guy that worked for a big video game company, right? He spent 4 years in university. The guy worked on all this graphic design, 3D modeling, and importing it and knowing coding. He gets this job at his dream job at a big gaming company. And guess what? The CEO comes in and says, hey, you've been working here for a year, but guess what? There's new software that designs everything that you do. You just need to use the software that designs and does all the imaginative work and does all the creative work. And your job now is to code it into the game. That's it. The dude was super depressed because things are just evolving so fast, and it's cutting the time of workers, and people are going to have a hard time. I'm hoping in my industry I can make enough to be comfortable in the next 3 to 5 years, because kids today need to be way more diligent than they ever have in the past, because there is no safe job anymore. I can't think of one. I argue with my dad about this in construction. He thinks construction is one of those jobs where AI and robotics will never take over. Yet I'm showing him videos of like literal 3D printers that are building the foundations of homes. And you're talking about modular housing and all this new innovations that are going to come, because housing has gotten too expensive. There's going to be things that are better mousetrap. and that stuff is just it's just gonna be nuts. It's gonna be really, really hard to keep up with. So I like dividends. I mean, I really got away from that question, didn't I? So I don't want to steer away. Let's round the question back here. I don't want to get away from growth. I think we could see a lost decade for sure. I don't know. Who the hell actually knows? But that's why I kind of go back to that Dave Ramsey style of thinking where don't put all your eggs in one basket. I mean, you want to have growth. You want to have dividend growth or dividends and what does he say? Growth and income. But Dave Ramsey always says you want kind of to look at 3 or 4 components of your portfolio and not just focus on one. Again, I don't like that idea of VTI till I mother freaking die. That's all you need to buy. I don't like that style of investing because you're missing out on those different market environments, right? Whereas even now where the market hasn't recovered to all-time highs, collecting dividends and reinvesting has probably boded pretty well for a lot of people, right? So moving on to, right, like, I mean, if you take a look too at the S&P price to earnings ratio, I'm slightly concerned at where it sits right now, just because we can't be going back up, guys. We can't be in a slowing revenue environment for the next year or two and seeing, this increased PE multiple. It bothers me immensely. I've never been that much of a fundamental investor, but this chart, I mean, it bothers me because this next earnings will be a huge defining factor. Because if things are continuing to slow, if Apple's continuing to slow, why are they going to keep going up? Maybe I'm wrong. But nonetheless, let's move on here. So I totally agree. Can you debate strongman finance on dividends and SCHD? Has been trashing those two things hardcore. Yes, I'd like to see this too. I watch a lot of YouTubers. Strongman's an interesting one. I think there's echoes from above. There's this whole like nuance of channels coming out where it's just hypercritical of basically anyone in the finance space. And I've kind of been a proponent to this. I'm not perfect myself. I've talked about stocks that like I've taken sponsorships from companies that have pretty much gone bankrupt at this point. The Very Good Butchers. I had a lot of faith in that company too at one point. But I just I don't, like I said, everyone's got their own perspective. I don't want to batter up Strongman. I think he's living in his own, world where, I think when you come from an entrepreneurial standpoint or a business creative standpoint, the risk that's required and the appetite for that risk and dealing with the volatility of it is something that Strongman doesn't have. He calls himself Strongman, but I think from the mental fortitude standpoint, I don't think he has that perspective baked in. I think he comes from a place of having kids, a family, stable work, buying stable investments. So, that's where his perspective is always going to bleed from. And I just don't think leaving out dividends, considering we know the proponent of dividends reinvested over long periods of time and not having to sell stocks to a lot of people, growth stocks, S&P, you could just sell it, right? You could just sell it, take profit, use that to live on. I don't like that idea. I love the idea of never selling an investment once you get to that place of retirement and just collecting it. Like with my parents, we've discussed this, because when you get old, you get decrepit, you get a little bit, dementia going on. You don't want to have to sit there and manage a portfolio, or then you're going to have to pay someone to manage. You have to trust people, and that comes with more risk. Whereas if you just have dividends that get cash in the account, you just pull the cash out as you see it. You never have to think about it again. You really wouldn't have to care about the market volatility or anything like that. So it's just my personal opinion. But again, I think a diversified growth and income, S&P broad-based, foreign stocks, I think it's, like I said, as a Canadian, it's easier than I think for a U.S. person. U.S. people just seem to be caught in U.S. companies, but as Canadians, it's very easy to pick Canadian stocks and buy some, U.S. It's easier to get diversified, I think. But still, watching your videos as always. You have good topics, and I love how you always lead by saying, I'll pass the question off to you. Yes, I want to try and continue the conversation, so we're going to do these live streams to us, the viewers, which involves us to get involved. I would not buy TSLY. That is an option strategy for those of you that don't know, to own Tesla and collect a crazy amount of cash flow. But I do invest in Hamilton ETFs and Harvest in the Canoe and Brompton. But I also hold dividend single stocks like TD, Enbridge, MFC, to name a few in my TFSA, but a little different in my RSP. I hold DGRO, SHD, SPYD. All three of these give me the U.S. exposure with no 15% withholding in my RSP, kind of a mixed bag of stuff. But DGRO has been one of my favorite ETFs, and I love what's in it, and the concept is wonderful. Yeah, I would have to agree. Like I said, I'm not a fan of a lot of the option strategy ETFs because they tend to just lackluster in performance over long periods of time. If you need income today, yeah, there's nothing wrong with them. But DGRO, SCHD, I kind of had to flip up the bait with a coin over this because they're both great dividend ETFs. I like SCHD. It has a better long-term, past performance. Not that it equates into the future, but with DGRO, you're getting exposure to like Apple, Microsoft. It has a little bit more of the dividend growth stocks. You're getting a lower yield, and I don't know what that means for the future here, but it's pretty much falling in line with SCHD. So it's not the worst stock, right? But I think SCHD is going to be my tried and true U.S. dividend stock. I'm hoping to buy a lot of this back once I get my real estate stuff figured out. and I don't have to necessarily pull out all the money from my RSP. I'm just keeping the cash liquid until I'm 100% certain. Real estate is a nightmare. I don't know how people do it so comfortably. It's like my first home purchase stuff, and I feel bad for people that have to deal with it. It makes me never want to own rentals. I don't want to get involved in real estate, but you need a place to live, and I don't want to spend $3,000 plus a month to rent. And I'm not moving to Alberta. I mean, that was a debate for a while, but we've kind of come to this conclusion. So let's get into it. What are your thoughts on Brookfield? Brookfield's great. I was constantly debating on buying it. I think the ticker's BAM. They manage like almost $1 trillion in assets, very diversified. It's like buying an ETF. It's almost like buying Berkshire Hathaway. I've always debated on buying it myself. It's been trading down, I think. Probably not going to do too wrong. I'm not sure. They own a lot of real estate. And depending on the office exposures they have, it's convoluted, right? Because I don't think you could ever understand the total investments that they hold unless you're buying the individual components. Because I think Brookfield also offers infrastructure partners. They do offer, I think, pure real estate partners. They do give you other proponents to the business that you can buy on an individual stock base, not individual stock, but a different stock ticker. But like I said, I've always had a hard time wrapping my head around it. But it's like the Canadian version of Berkshire Hathaway. 30 years later, none of those companies are around. Well, they are, though. That's the thing. Almost a lot of them are the S&P top 10 companies. I mean, almost the vast majority of them are actually, I think most of these are still around. I mean, read through them, right? Like a lot of them are actually would have been fine. You might not be crazy returns like some of the newer ones, but I mean, Johnson & Johnson's still there. I mean, Walmart's definitely still there. Intel's still there. IBM's still there. Time Warner, AT&T, Verizon, Coca-Cola. I mean, hell, you could have picked your own favorite of these stocks. Procter & Gamble's done amazing. Philip Morris, Home Depot, for crying out loud, Bank of America. 2001, if you pick companies that you really liked and built a diversified portfolio of just the top 20 stocks, there's a good chance you outperform the S&P 500. I don't think things change as rapidly as I think if you look at like smaller cap companies, there's more risk because I think that the vast majority of those things, they like bankruptcies, especially if anything over the last 2 years have taught us anything, you got to be a little bit more mitigated with small caps, right? But I think people under anticipate the value of those upper weighted companies. Not all of them are going to be around. General Electric, not all of them are going to do well, but that's why you're not putting it all into one. Kyle, 3 years, 5.25%. Or 5 year. Oh, you're talking about mortgage rates. We're looking at, where are you getting those rates from? I don't think those rates exist anymore. What bank are you using? Please let me know. The rates we're looking at are around 5.8%. And those are special rates. You can't even find those on websites right now. I think Scotia's even offering 8% rates. I mean, it's competitive out there, but that's why we want to buy now. Why not buy when everybody is scared and it's hard and there's nobody chasing and bidding properties up to the moon anymore? I figure this is the best opportunity of our lifetime to get into real estate. And then if they lower interest rates, we're going to get a 3-year fix in 3 years. Maybe the rates will be down. We'll lump sum a larger payment into it and we'll see our payments drop in half. We're lucky. Pre-approved. I'm working on it. My man. I'm super confused on what you're saying here, Kyle. What aspect, good sir? I'm very confusing sometimes, but the market is as well. You got to take what I say with a grain of salt because sometimes it might not make sense because I don't even always make sense to myself, right? The magic man. I don't like the idea of a VTI till the day I die. I don't like that style of investing because you're missing on different market environments. Can you further elaborate? So, it's hard to say because a lot of people, it's just a matter of you don't want to miss out on like more concentrated growth. If that's what you're into, you don't want to miss out on dividend compounded growth. I mean, again, a lot of people say once you diversify enough, you might as well just buy VTI because that's what you're doing. But I largely disagree with that. I think if you buy something like SCHD or you find some really good proponent in individual things, like I love Procter & Gamble, I love Pepsi. I think you could buy those companies individually. I think you could just reinvest the dividends, and that dividend growth plus the compounded reinvested dividends, I think is more precious to me than buying something like VTI that pays hardly anything in a dividend. You get the broad market. You're weighting a crap ton of stocks with most of it just being the S&P 500 anyways. Whereas I would rather just pick an S&P 500 ETF, forget VTI and getting crazy. VTI is the global one, right? That gives you most of the market weighting in the S&P 500 and then some global stocks, Asian, Canada stocks, whatever. I'd rather just pick the Canadian stocks I love because I trust the Canadian economy, pick the S&P 500, and then again, weight 10% individually for me. But again, I really got to do a full portfolio update. It bothers me because I haven't been comfortable enough. I haven't talked about it with my fiance, but maybe I'll do a portfolio update, not showing the values, but showing our total investments. Because like I said, I own crypto. I'm largely against crypto. I think there's going to be a huge bull run in the gaming cryptos. I think it's going to what's going to revitalize crypto. I don't talk about it. I play in a lot of different realms still. I just try not to talk about it because of scammers, right? So is VTI US only? Okay, so maybe VTI is the US only. What's the global one? Because There is one there that gives you a little bit more broad-based exposure as well. As TSX 60 top 20 from 2000, what's with those companies? That's a good question. I'd have to double check. The top 20, even the top 50 companies in Canada haven't changed. I mean, most of them are exactly the same, right? Like you can name most of the banks. Telecom giants haven't changed in 15 or 20 years. You got gold companies like Barrick Gold that's been here forever. We're a very commodity-based industry, so you're going to get your oil companies like Suncor that's been there, and Bridge. I don't think they've changed out that much because the banks have always been of the largest companies, but that's going to change. I think you're going to be looking at things like Constellation Software, very expensive company, but it's been one of the best performing Canadian stocks ever, like really doing better than even Shopify I think it's at all-time highs right now. But Shopify, Constellation Software, the very few software companies we have, I think will eventually replace the likes of our banks. It's just going to take a little bit of time. But nonetheless, I'll finish up with a few more here. Phil B, too much debt. They needed to trim fat. I'll have to take a look at that if you're talking about BAM, or what are you saying here? 100% return has nothing to do with reverse splits. And I didn't say to invest in GE. My point is GE, which was dying, is having some sort of revival right now. Like I said, I'm just making some anecdotal points here, nothing too crazy. I mean, like I said, take it what I'm saying with a grain of salt. I'm just saying you might not do that bad picking S&P top 10 companies over the next 20 years. You might not. I don't know. But is Northwest Healthcare REIT a good buy? Dividends seem high and the stock price dropped recently. I don't trust any Canadian REITs outside of maybe, like I said, I still like RioCan, but you're not getting growth out of these guys. Give up on growth from REITs. Most of them are dead. They're long. I love Granite. I'd focus on Granite. I'd focus on ones that have better debt. I mean, even look at Allied, right? Like Allied's trading in the toilet and it has a 30% debt to asset ratio. I mean, it doesn't make any sense, but the cash flows are hard to predict because interest rates are skyrocketing, office is dying. Even the office REITs that a lot of companies have been renting to the government wants to subsidize all of their real estate and turn it into residential because most people are going to be working from home. Everyone's like, don't go back to home. No one wants to go back to home office. All these big companies saying you're going to come back to work, but then you go to New York right now and New York office is destructive. It's just hard. Be careful with REITs. I think if you don't own real estate, if you don't have a huge proponent, go ahead, buy things like Cap REIT. I think are great. Cap REIT, Granite, amazing. RioCan or Smart Centers for Income. Just keep it mitigated. Don't buy a broad-based REIT ETF. They're garbage. The returns have been abysmal because they weight everything too equally, and you don't want equal real estate exposure. I even go to Realty Income. I think go to the US. I think there's better REITs in the US than in Canada right now, just because the rates are going to kill them. I mean, it's really hard to get good rates of return out of the Canadian REITs in this higher interest rate environment for the next little while until rates come down. I think when rates start coming down, that's when REITs will have a resurgence in life. Again, it's a complicated topic because interest rates are up, and for the next few years on mortgage renewals, it's going to either cash flow to selling properties to pay off debt. Yeah, they're mitigating some debt, but I mean, their debt to assets amazing. I think their net asset value, their net is what it's like 7 billion and the company's trading at what 2 billion in its market cap or something. Yeah, again, I'm not buying REITs for growth. If you're buying REITs, try not to focus too much on growth, focus on income. And it's more or less for income today. And I'd be careful how you buy them because they're counted toward regular income. They're not counted toward like regular dividends. So you end up paying full income if they're outside of tax advantaged accounts. They're a lot more convoluted, right? So again, I'm trying to get my real estate exposure by owning it for the first time in my life. So the most expensive place in the city. I can't wait to make that video the title of me buying in the most expensive city pretty much in the world. The craziest growth, the hardest market, because we're trying to buy in Toronto. It literally, I can't wait to get that address that says Toronto just to say we pulled it off somehow in this wicked market environment. One thing I don't like about REITs is slow dividend growth. Yeah, that's the thing, right? You get higher yield today, but you don't get the yield growth. But anyways, folks, I'm going to continue this conversation. The content on this channel is going to be changing. You're going to get a slew of hopefully more intriguing other perspectives that go beyond what I'm doing sitting at this freaking desk. I'm really excited to be trying something that I don't want to spoil yet. I'm putting some content together over the weekend with some people that I think is going to be very unique and very different. And I'm also just going to keep doing these live streams. If we're bringing it back every Friday, which we'll see how that goes, but we're going to try and do it every Friday. And I appreciate everyone that stopped in tonight. You guys have literally put me in the position to buy real estate. You put me in a position where I actually got my full-time job from doing this YouTube channel. I have this amazing income of something I never could have imagined 5 years ago. The market's changing. Our lives are changing. And I'm glad that this has been a place of continuity, hopefully for some of you. And it's been a place of solidarity and, a place of comfort for me. And I hope it continues to be that way no matter what happens. The drama, the craziness of all these YouTubers and what it brings moving forward. And I'll be here with you, folks. So let's enjoy the ride together. Have a great night, and I will catch you around. Peace.